What's up, guys? Your agent Tyler Wayrung here, and today I'm going to talk to you guys about a big change going on for me and something I've been getting lots of questions about. So I thought it'd be good to kind of talk through my thought process and kind of how I'm going about thinking through the decision to sell my entire rental portfolio. So I imagine, like a lot of people I've been talking with, this probably shocks you guys as well. As you've been following me for any time, you know I spent really the last 8 to 9 years building up my rental portfolio. Up to one point, got up to 25 units, a mix between apartment buildings and single families and kind of anywhere in between there, with the goal to ultimately build up enough passive income to quit my day job and kind of give that financial freedom, if you will. So with that goal in mind, you might be thinking, why the heck are you selling then? And so this video, I'm going to talk to you guys about why I'm selling, maybe some considerations that may help you if you're in a similar position or if you're still on the journey of building. So really, in a nutshell, the biggest reason why, and I'll first just go out and say that I'm not done with real estate. I don't think everything's coming to an end and I'm just chucking dodges and getting out. I'm actually trading, in my mind, trading the current equity position I have in and hoping to re-leverage that for a bigger property, commercial property, something larger, right? So in the game of Monopoly, and a lot of people talk about this, the whole turn houses into hotels, which I'm not necessarily looking for a hotel, but the concept or the idea of taking something small, rolling it up into something larger, and that's ultimately how some of these investors go from starting out in single families and growing into these very large corporate investors. And so, like everyone, when I first got started, I had a very limited budget, and so obviously, we shop with what our budget can afford. At least that's the mindset I came into this game with. And so with very little money, I shopped for the cheapest houses in probably the worst neighborhoods. And so while I was still able to find good properties, undervalue, kind of put that value in, execute the BRRRR model, and get those rented back out, over time, I've just realized that while the rents in the areas that I initially bought in were really good, the rent to price ratios were really good, I'm still managing a level of tenant class that I'm not super happy with. And so what that means is, certain areas attract certain types of people that don't necessarily share the same value set that I do. And so there's lots of debates and conflict and just, everyday things with managing tenants that are willing to rent properties in some of the C and D areas that I do hold some properties in. And so part of this whole initiative to sell and kind of reset is really to get all the way out from where I'm at now, come into it brand new with everything I know today and with my current vision of the future. So now I'll be looking at buying larger assets to either, if it's in the residential space, to have it be more of a B and A type area that'll attract nice, great people. And essentially the lens I'm looking through everything now is, would I be willing to hand this property down to my children, right? So in the beginning it was, hey, does this pencil out on paper? Do I think I can get this undervalued and get it up? Where now I'm kind of looking at it from, okay, obviously it still has to generate income, but is this an asset that I think I would like to hold for the foreseeable future, and I'd be comfortable handing this off to my children when they become the age to really take this business over. So also from an equity standpoint, if something you're not tracking today is something that you really need to be tracking, and that's a concept called return on equity. A lot of people are familiar with return on investment, or ROI, which is something that is very important as well. But once you have a property for several years, you really need to start looking at your return on equity. And the reason why return on equity is important is it really evaluates your investment asset agnostic, or which is a fancy word for saying, if I had that same amount of equity in stocks, or if I had that same amount of equity in, another asset, how do I measure these all apples to apples? Basically, if I were to take my equity out and put it into something else, could I generate a better return? And so when real estate appreciates, your property value goes way up, your equity position grows, and then that same return that you were getting when you just originally had a low equity position, like 20%, in most examples with investment properties, when you start to turn that into a 50, 60, 70% equity position, those same cash flow returns are very low from a percentage standpoint. So let's look at an example here. if you had a $100,000 property and you had 80% debt, so that would give you a 20% equity position. If that property was bringing in, let's say $12,000 a year, let's keep the math simple, $1,000 a month, $12,000 a year. That $12,000 a year against your $20,000 equity position would be a 60% return on equity, which is fantastic, right? So, but as you start to pay that property down and the value of the property goes up, let's say now the property is worth $250, which in my case, most of my properties have doubled or more than that over the last 7 to 8 years. And if you've been buying, since 2016, 2015, like myself, you're probably in a similar boat. So let's look at that same example now, where let's say we've paid the property down to $70,000. We owe $70,000 on it, and now it's worth $250. So in that case, you would have a $180,000 equity position. Let's just say, for example's sake, that you're still making that same $12,000 a year. Hopefully that's gone up as well, and in most cases we have seen that it has. But for example's sake, if you were still making $12,000 and now your equity position is $180, now you're at a 6% return on equity, which is very poor. And so the way that I said you can look at this against other assets is the stock market returns 12% a year for you not having to do anything. You just buy a stock. If it's an S&P 500 historically, you just buy it, forget it, they manage everything, and you make 12%. So why would I hold a piece of real estate where I have to manage tenants, repairs, things like that for less than a 12% return? So if I'm making 6% on that equity here, right? Do you see where I'm going with this? It just really doesn't make sense, and which is why you want to keep measuring that return on equity. Now, you might be saying, hey, didn't you write a book about HELOCs? This is a great opportunity to tap into that equity. Or couldn't you do a cash out refinance to pull that equity back out, lower your equity position to increase your return on equity? Yes, I could do all those things. However, unless you've been living under a rock, interest rates have gone through the roof over the last year or so, and I'm holding very low interest rate debt right now. So it'd be really kind of silly for me to double, triple, and even some cases 4x my interest rate just to increase my return on equity. Now, however, if this was a phenomenal asset, something that I was super proud of, really enjoyed managing, and wanted to hand out to my kids, yeah, that might be something worth looking into. But in this case, most of these are just properties to me. I don't get emotional about them. These were deals that made sense when I got into them, but now I'm just ready to kind of hop back out and see what I can do, taking all of that equity and rolling it in to the next deal, set of deals, or the next venture that I'm looking to get into. So another big thing that I've been getting is, well, what about the taxes? You're about to get killed in taxes, which is pretty much true, right? So when you sell a property, you do have to pay capital gains and depreciation recapture on all that depreciation up front for those properties. And so a lot of you may be thinking, hey, you should 1031 that into a new deal. And in fact, I'm not going to do that, right? I do understand the benefits, and I know that, everything that goes into that thought process. However, a couple things that I don't like about the 1031 is the time pressure that you're put on to go out and find a deal within a certain amount of days. And oftentimes, even clients of mine, I've seen them force their way into deals that they weren't super happy with just to conform with the time commitment. So you may be saying, dude, there's lots of ways to get around that. Honestly, to be transparent, I'm just not willing to put in the effort at this point to go out and find a deal that's specific to match up with all these timelines. I'm selling a lot of these properties in one-off scenarios, so it'd be very difficult to roll multiply all these sales into one larger property that I'm looking to get into. Is it possible? I'm sure it is. I'm just not willing to go through all the headache to do that. I'm really fine with carving out a portion of this sale, putting it in a bucket for when tax time comes, and moving on and forgetting about it. We touched on taxes a little bit as well, but also something to consider is looking at your depreciation schedule. Now, if you've done a cost segregation study and you've maxed out the depreciation on your property, or even if you hadn't and you've held this property for over 27 and a half years for residential property, that's the term that you can take depreciation against the property. So whether you've maxed that out or you're at the tail end of that, that may be another consideration for selling your property and getting back into something else that you can take higher amounts of depreciation on. So I took heavy depreciation up front. Obviously, I'm going to pay that back when I recapture, but my plan ultimately is to put this into a larger asset that I can again take that higher depreciation up front with a cost segregation study that I'll be looking into. So that may be a little advanced, but just a perspective to think about as well from a tax perspective if that's something that's on your mind when it comes to selling your property. I hope that's helpful just to kind of share what's going on in my real estate portfolio, the whys and the thought process, why I came to my decision, but really, at a high level, the things that I covered and that may be helpful for you to think about as well is, has your property value increased a ton, and how is that impacting your return on equity? And is that equity honestly giving you the best return where it is, or could you exit via selling and put that somewhere else to create higher and better returns on that money, or increase the velocity in which that money is turning over? I touched on why, if you're holding something that's really not something that you want to hold forever, maybe a good opportunity now to get out while the market is still up. Trade that in for something that you're more long-term aligns with your goals and what you're hoping to do with real estate, rather than hanging on to these troubled properties that are nothing but a headache, even though they generate decent cash flow in the meantime. I've honestly really just come to the conclusion that if you're wanting to grow as a real estate investor, grow your portfolio, you ultimately need to trade up here and there. You can't just be this investor that holds forever, gets these properties paid off, right? So that does help from a cash flow perspective. But if you put $20,000 down, you get it paid all the way off, where is this next set of money coming from that you're going to continue to buy and grow into these larger real estate deals with, right? I mean, it's possible if you earn a high income, but if you're really just a hustler, you're really just out there grinding in the real estate industry, you really need to be trading in these equity positions, trading up in property value and bigger deals in order to grow. Now, if you're not looking to grow, if you're happy with the portfolio you have and you're just looking to chillax, collect your cash flow, you're good. Don't start throwing darts and arrows at me. I'm not saying everyone needs to sell, but if your goal is to grow, this is a consideration that wasn't obvious to me in the beginning, is the fact that you really do need to turn over that equity frequently in order to grow it and kind of get that snowball going and getting you in a position to be in the game for bigger deals. Just about every one of my properties, like I said before, at least doubled, if not more than that. So I'm sitting here with at a minimum, I had a 50% equity position across my portfolio. So I thought to myself, is this cash flow adequate, or could I take all of that equity that's at a 50-50, equity to value ratio, and could I then put that down for maybe a 20-25% down payment on something much larger and get my equity position lower, which seems counterintuitive, but now I'm able to buy something. Let's say I have $1 million of equity sitting here. Now I can go out and buy $5 million worth of real estate, whereas before I only had $2 million worth of real estate if I had a 50% equity position there. So you're basically trading up, lowering your equity position, but again, bringing that leverage into the game to get your return on equity up on a much higher dollar figure there. So guys, I hope that was helpful to at least talk through that. So I know some of these concepts were a little in the weeds and really kind of nerding out on the math here, but I know most of you guys out there are just like me and like to dig into the numbers as well. But I'd love to hear your perspective if you're in a similar position or you disagree about my approach in general. I think that's how we all learn and grow together. Drop those in the comments below if you haven't done so already. I'd love to hear and chat with you guys there. But as always, I'm super grateful for the support, you tuning in, watching this video. And with that, guys, I'm Tyler Wayrung, and we'll catch you